today's topic, the big, beautiful bill, the real estate game changer, and really how one bill can reshape buying, selling, and investing for years to come, or literally. So there's a lot that we can uncover. I don't know if 45 minutes is enough. We'll try, Thomas, right? We will definitely try. So today we have an honor to have Thomas with us, Casetlli, and he's a partner, he's a partner in a Hall CPA firm, which the firm does tax and accounting services specifically really for real estate investors. And I want to ask you, do you guys also do other businesses, or do you really try to kind of hone in on the real estate investor agent avatar?
So we work primarily with real estate investors. However, having said that, we do have quite a bit of real estate agents and brokers who work with us. Some of them are just on the real estate agent and brokerage side because long story short, we work exclusively with people who are in real estate. With that is we have like real estate agents and brokers. Many of them do invest in real estate who do work with us. However, we sometimes work with just agents and brokers who are just doing that. So
Yeah, nice. Perfect. Okay, I just want to make sure I described it correctly for you.
no
Awesome.
problem.
And the way Thomas and I actually met is really through Bigger Pockets. I heard of their firm being very active there, very well just promoted, and a lot of people vouching for them. And I told Thomas when I spoke to him, this is now a few months ago, I was like, man, it's so hard to find a accounting firm for investors, right? And I've been through, honestly, I think 3 accountants, CPAs, in the last probably 10 years. The one I have now, and full disclosure, it's not whole CPA right now. I'm happy where I'm at, but they don't take any more clients. And that also happens, I guess, the good ones, they get busy and they don't want to maybe scale, and then they don't take on more business. But then I have people like you guys asking me, or Eric, like, do you guys have a CPA you recommend, or this or that? I was like, gosh, man, I don't have anybody that I can trust. So then I started meeting a few people that they do business with Hall CPA, and that led me to Thomas. And then we connected. I talked to some of the clients. I was like, perfect. I was like, can I bring you and start talking about these topics that we should talk about within investors and agents here? So that's kind of how it all started. So here we are. That's how we met. But Thomas, I read quite a bit about you. You have a pretty cool story. You're a lifelong entrepreneur. Started selling eBay, fixing computers. Is that the start? Is that what?
Yeah, so I can kind of give you the breakdown. So like since I remember I was 5 years old, I was standing in my grandmother's walkway in our house, and I was telling my parents I was going to be in business. So kind of goes back all the way from 5 years old, but throughout the years, I did like little odd jobs and always figured out a way to make money, whether it was doing a computer repair, it was going around washing cars, hosting like what are those things called again? I can't believe I can't remember the name of them. Garage sales,
Garage sales.
selling
Yeah.
things on eBay. There's always something going on where I was trying to figure out how to make money as a kid growing up. And then ultimately, went to college for accounting and business development, excuse me, and business management. And then during that time, I started to realize, okay, entrepreneurship, business ownership, that's going to be the way. That's really what's for me. So I started investing in real estate. Right out of college, I went to like a syndication 3-day weekend where they taught me all about real estate syndication, raising capital, buying multifamily properties, things like that. So I ended up syndicating a deal with a few partners back in 2017 that had went full cycle. We sold that during COVID, which was an interesting story, but I'll spare the details for now. But that was interesting, and now I continue to invest as a limited partner, and a lot of my active time I'm in business is here at Hall CPA doing various things, whether it's like starting up a podcast or starting up a new business unit, whatever the case may be. A lot of my entrepreneurial efforts are focused here at the CPA firm.
Awesome. Yeah, and you're a partner there,
Right.
correct?
Yeah. So I'm an equity partner, so I have equity in the company, and yeah, so I'm a part owner.
Yeah, it's always good to speak to somebody, right? Especially when they're doing your taxes that actually does investing. I think that should
Yeah,
be a prerequisite for all
super unique.
for all CPAs that want to do, taxes for real estate investors. And you're one of them, which is awesome. So, Eric, anything you want to add before we jump into some questions?
No, I think just kind of repeating that, like I've talked to so many CPAs about real estate and stuff like that, and a lot of them will handle it, but they don't have like a full grasp of it. So I think it's awesome that you not only invest in there, but have done it yourself. So it's awesome.
Yeah, no, I appreciate it. And I'll go ahead. I'll drop my some information in the comment section, and if you do want to check out more, but I'm ready to go whenever you guys are.
Yeah,
Yeah.
absolutely. So I guess just give us like the, high level, maybe overview where you would like to start, right? Discussing the bill. I guess, and it would be good to know maybe what things we had in place that maybe went away and now came back, and what things maybe, were extended, and then we can kind of dive deeper into some of those topics, right?
Yeah, absolutely. So, from a high level, the One Big Beautiful Bill Act, as it's officially called, is really more or less like an extension of the Tax Cuts and Jobs Act of 2017. It's almost like the TCJA Part 2 or 2.0 is how you can really look at it. There wasn't a crazy amount that was new that was added. Some things were made permanent, and we can go through what those are. Some things were simply extended, and then other things were more or less renewed. So, not much. I guess what I'm trying to say, not much of it was actually new. It was just
Really?
like things made permanent, things were extended, and then some things. Yeah, that's pretty much it. That's pretty
Yeah.
much the extent of it. I'd say the biggest thing to hone in on, I think, for a lot of people tuning in here is going to be the return of 100% bonus depreciation. So from the tail end of 2017 till the end of 2022, you could fully expense the cost of property that had a depreciable life of 20 years or less. And for real estate investors, that meant that usually when you buy a property, whether it's residential or commercial, there's going to be the actual building and the structure. And then there's also going to be components that have a depreciable life of either 5, 7, or 15 years. And somewhere between 20 to 30% of the building's value can be reallocated to this 5, 7, and 15-year property and fully expensed. And that sunsetted started in 2023, dropped down to 80%, then it dropped down to 60% in 2024, and it was going to be dropping down to 40% in 2025. But then they brought it back and made 100% bonus depreciation permanent, which means there is no phase out. It's not going away any time in the foreseeable future. And that is a major, major win for real estate investors. To kind of give you just a quick example of what that might look like, let's just say you had a $500,000 property, and land is never depreciated. So we always have to factor in land value, and it differs from location to location.
Right.
But if we assume 80% was land value, excuse me, 80% was the building, that's 400,000. And then basically what happens is if 25% of that, just on average, split the difference, is reallocated, you're going to get a deduction of $100,000 on ballpark on that type of property. And that, if you're at the 37% tax bracket, just to kind of give you an example, that's worth $37,000 in tax savings. If you're in the 24% tax bracket, that's worth $24,000 in tax savings, so on and so forth. So this is by far probably the most impactful thing for people who are in real estate. And I would say this for real estate agents and brokers, if you're getting paid on a 1099 basis or you own your own brokerage, you're going to be considered most likely a real estate professional if you're doing this full time. And as a real estate professional, what that allows, so if you're not a real estate professional, any loss generated by on rental real estate is considered quote unquote passive. And what does that mean? That means that it can only offset other passive income. So it can't offset your earned income from a job or a business. However, if you qualify for the real estate professional status, which is you spend more than 750 hours and more than half your total working time in a real property trade or business, then you qualify. And what that means is that the losses from your real estate, which are largely going to be generated by bonus depreciation, can help you offset your earned income. So that's really impactful. And I know there's a lot of real estate agents. I don't know about this room specifically, but a lot of real estate agents and brokers out there that have no clue about this. right? No clue that this exists, or maybe they know it exists, but really don't know the impact it can have. Because
Yeah.
there's a lot of high income doctors, tech professionals, lawyers, attorneys, sales professionals who are dying to get the real estate professional status and will try to bend over backwards to try to get this, because they might be making a few $100,000 or perhaps even seven figures, and they're like, oh, I'm paying all this money in taxes. If I could just buy a rental property and turn the losses non-passive, I'd be able to save myself 5 to 6 figures in
Oh,
taxes. And real estate agents and brokers, you're already there. You're already there. You know what I mean?
I can speak to that. Well, one of my good friends does a lot of passive investing. So he's not technically a real estate professional based on the guidelines, right? Because you have to be active, right, in it. So he became a partner in a property management company. So he can, and that's where the active part comes in. So he can have the status, because to him, it's so important to have access to the depreciation that you're describing against his income, right? And I can vouch for also another thing. I invested into an RV park actually twice, and it was during the 100%, when it was in 100%. And I literally, RV parks have even additional kind of I guess bonuses there that you can depreciate easier. I ended up getting 120% of what I invested back in the first year as a write-off against my income, right? Anyway, so there's just things like that you guys, it's so crucial. So I would say, yes, that's one of the most important things. And one of the things you and I discussed, and we exchanged some emails, you said, like for real estate agents, what, as far as the changes about the tax brackets, the standard deduction, the lifetime gifts and the state exclusion, like, is there anything specific there you can add on for us agents?
Yeah, so there's a few things that were going to sunset this year. So at the end of 2025, so moving into 2026, these are no longer going to be here. So the first thing is tax brackets. Before the Tax Cuts and Jobs Act of 2017, the top tax bracket was 39.7% or 39.9%. I forgot the exact percentage. It was 39 point something, and that was going to be the top tax bracket. And that was going to revert back. But the One Big Beautiful Bill Act made the current tax bracket scheme permanent, and that tops out at 37% at the federal level. So that's big. That's here to stay. It's now permanent. Additionally, the standard deduction was much lower. The standard deduction was just roughly about half of what it is now, and this was also set to sunset in 2025. But they made the new larger standard deductions permanent. So it's going to be $15,750. This is 2025 numbers. If you're single, that's the standard deduction is $23,625 if you're a head of household, or $31,500 if you're married filing jointly. And these bigger deductions have been made permanent, and they're of course indexed for inflation. So every year the IRS will release the new standard deduction number, but for 2025, that's what we're looking at. And there's also the estate and gift tax exemption. That was that used to be around $5 million per individual, and then that was also indexed for inflation. But they permanently raised it to $15 million starting in 2026. So that's substantial. And what that does is that eliminates the cliff. So long story short, if you didn't have your estate plan in order at a certain time, you would revert back to the old numbers. But now that's no longer an issue. It's been made permanent. So if you have a large estate, that's big for you. I'd say that's kind of high level from the brackets, the standard deduction, lifetime gifting, estate exclusion. That's kind of what we're looking at.
Yeah. Cool. Eric, you want to ask the next question?
Yeah, so couple things to that though, just starting out, like, what do you think if you just had to, because I had this kind of when we were planning on talking, what do you think is the biggest impact change from this? Like just high level, like what do you think is going to be the biggest like benefit to agents and or investors? Is that like kind of the first point we talked about, or is that like once you read through this, like is there anything that you think is just going to have like a huge impact?
Without doubt, by far, in my opinion, by a mile, it's going to be 100% bonus depreciation.
Okay, that's what I thought.
By far.
Yeah. Okay. Cool. So who benefits from the SALT cap increase? And how does the phase out threshold impact high earning real estate professionals?
Yeah, for sure. So if you live in a high, so basically, long story short, the SALT cap is your ability to deduct state, local, and property taxes against your federal income. So if you live in a state that's property tax, before the Tax Cuts and Jobs Act of 2017, you were just able to deduct the full amount. So if you paid, just call it $50,000 in state taxes, just making up a number, to the state of New York, you would just deduct that against your federal taxes. The Tax
Hmm.
Cuts and Jobs Act put a limit, a cap of $10,000. Now, that impacted people who lived in high income tax states like New York, California, so on. There's other states, so on and so forth. Um, and there's a lot of pushback against that by the people who lived in those states. So what the Tax Cuts and Jobs, what this did is it raised it to $40,000, raised that SALT cap from 10 to $40,000 for people who are earning less than $500,000. However, this begins to phase out from $500,000 to $600,000, and when you're at $600,000 of AGI, it goes right back down to 10. Basically, if you're earning under 500, you're in good shape, and you could take the full $40,000 deduction. But if you are earning more than that, it will begin to phase out, and then it's back to 10 at $600,000 in AGI. So that's kind of what to look at from a SALT perspective.
Okay. That sounds like a good opportunity for me to call some New Yorkers and see if they want to come down to Florida. Just, hey, no income tax.
Oh yeah, I just made the move from New York to Florida in 2024. So yeah, I hear
Yeah.
definitely.
You were looking ahead. You were looking ahead. Awesome.
And as far as the auto loan interest deduction, what are its limits now?
Yeah, so there was no auto loan interest deduction for quite some time, and the reason I'm mentioning this is because I know a lot of people are going to be talking about it. So the maximum deduction you could do is $10,000 of interest. It does come with certain restrictions. It only applies to passenger vehicles that you originally bought. It excludes fleet commercial lease vehicles. Excuse me, commercial vehicles, leases, and salvage title cars. I don't know how relevant that is. But the vehicle also must be assembled. Doesn't have to, all the parts don't have to be made in the United States. However, it has to be assembled in the United States to qualify. And then it starts phasing out 100,000 after $100,000 if you're single, and $200,000 if you're married filing joint. So that's reduced $200 for every $1,000 over 100 if you're single, and 200,000 if you're married filing joint. So if you're earning more than that, it's not going to be you're not really going to be able to take a huge advantage of it. But I just wanted to, I wanted to put that out there because I know a lot of people are going to be asking about that.
So let me ask you, so you're talking about this is against your personal taxes, or this is business car?
Yeah, so this is a personal vehicle. So,
Okay.
so say for example, I bought a Ford F-150 and I pay $12,000 of interest on it per year. I would be able to deduct $10,000 of that interest against my income, just be a deduction against my income, assuming it meets these criteria, including being assembled in the United States, which of course a Ford would most likely. And then but then it phases out over 100K of income if you're single, or 200 if you're married.
Got
Do
it.
you
Oh,
go
go
ahead,
ahead.
Randy? I was going to say, so the CPA that we work with currently, which I'm going to be talking to you after this because a couple things recently, not the biggest fan. So I'll be setting up a intro call with you. But like we write off our mileage, but I've also heard, you can also write off the whole vehicle if it's 6 tons or 2 tons, I forget what it is. So is there one you typically tell people? Like, I'm not going to go out and get like a crazy luxury vehicle to write it off, but do you see one typically work best as like an agent investor?
Yeah, it's a great question. The auto loan interest that applies to personal vehicles, to just like personal use vehicles. Now, if you're going to have a business use vehicle, there's 2 ways you can deduct the business use of it. The first one is going to be the standard mileage deduction, which is simply the standard mileage rate times the amount of business miles that you drove for the year, and that's going to be your deduction. The current standard mileage rate, I'm just going to take a quick look at it. It's like 60 something cents, but I'll let you know what that is right now. Mileage rate. That is, it is, okay, it's 70 cents per mile. Okay, so
Nice.
it was 69 point something. I guess they raised it to 70, but 70 cents per mile times the business mileage. That's one way to do it. Now, if you use the vehicle more than 50% for business, you can use the actual expense method. And the actual expense method allows you to deduct the actual expenses related to the vehicle. That includes interest. So there's no cap on that. On the business,
Okay.
there is no cap. That also opens if you have a vehicle that weighs over 6,000 pounds. It's a gross vehicle weight rating, so it's a GVWR they call it, and you could find that on usually the vehicle's website, or on the door of the vehicle at the actual dealership. And those vehicles are eligible for, they're considered non-passenger vehicles. Consider a Ford F-150, for example. And if you use it more than 50% for business, you can bonus depreciate the business portion. So say, for example, you bought a Ford F-150 for 100 grand and you use it 75% for business, then you're able to bonus depreciate $75,000 of it. And with 100% bonus depreciation, now you get a full deduction of 75K. If you use it 100% for business, it'd be the 100K, the full cost of the vehicle. So if you're an agent, you're using a car exclusively for business or majority for business, this can be a really lucrative deduction.
Interesting.
Yep.
So what if you have a car that you use, you know, like you said, 50% business, 50% personal, I'm tracking miles, I'm deducting the miles under the business P&L. Can I still then take the interest that we were discussing earlier?
Yes. So the standard mileage deduction is just a flat deduction. It's just like I'm choosing, hey, I'm going to use the standard mileage rate for whatever reason that might be simpler, or whatever the case may be. Maybe you're using the vehicle under 50% for business. That's just going to be a straight mileage versus times the rate, and that's what you're going to get. There's really no other real deductions with that. If you're using it more than 50% for business, you could use the actual expense method, and in that case, you get access to all those other deductions. Having said that, though, I would say that if you sometimes, depending on how much you're driving, the standard mileage rate may actually be better. There's been circumstances, and it depends, but there's been circumstances where we've seen people draw, investors or agents, business owners, drive so many miles that it actually makes sense just to use the standard mileage rate, because over time you're going to get a higher deduction than by just using the actual method.
But what happens to the interest that we were discussing earlier, on personal vehicles, right?
You can do that no matter what, because that's just personal, right? That's not your business.
But yeah, but
I see what you're saying. If you're using it 50 personally, that's a good question. I'm going to be honest with you, I don't have the answer for that right off the top of my head. I have to do some digging for that. But I'd have to look into that personally to see what the answer is. I'm going to be transparent. I don't know the answer to that question, but it's a good question.
I mean, assuming we could probably then take 50% of the personal, interest towards the deduction on the
personal side of it.
That would be just the logical thinking for me, right? But I didn't make the
I was gonna say, rarely is our government logical with anything. So,
so that's something like I'm fortunate that our team, we have a national tax manager at our firm who dives deep into all these bills. So if I asked him that question, he'd just be able to give me the answer just like that. I just personally just don't know that answer off the top of my head, unfortunately.
Yeah, and you guys, so this is good to know. So you guys have how many people you have, on your team that is doing the tax preparations for all your clients?
Yeah, so that's a great question. So we have a total of 100 staff, and a little north of 100 at this point, and the majority of them are doing tax preparation or tax planning. And those are the technical staff, and they go through extensive training when they onboard with our firm, and then they also go through weekly trainings with the head of national tax. So surprisingly, if I were to ask one of them what the answer to that question is, they're going to know. But I'm at the point where I'm not doing as deep of client work at this point, so I don't have all the nuanced answers, unfortunately.
Yeah. And just so the audience understands, so what you're obviously a partner, so you're more involved in, like we said, getting on podcasts, having your own podcast, getting the word out for the company. Do you also do strategy calls with certain clients? Like what's your role? I know we're getting a little bit off topic, but I think it's good for them to know, for the context.
Yeah. So I'll kind of give you an overview of how I got to where I am and what I do now. So I started off at the firm as a tax preparer. So I did a lot of tax returns, filling out the forms and all that. Then I became a tax advisor, and I did tax advisory for 4 years, where I advised clients one-on-one. Then from there, I built out the tax advisory team. So the team that does the consultations and the tax strategy one-on-one with clients. From there, I eventually hired a manager. They managed the team of advisors. And then I moved into basically I ran our sales department for a few years and ran one of our client communities. And then now I just run our sales team. I run our business development team. So I do things like podcasts. I'm on calls with new prospective clients. I manage our affiliate partnerships. Um, I do like webinars and stuff like this. So
Yeah.
that's kind of what I do at this point.
Got it.
Awesome.
Awesome. Cool.
We had somebody bring it back to the car conversation. This should be the last one, but they were asking if you can use gas receipts. I don't think the tracking your miles is going to be your best option there.
Gas
So
receipts, question, Thomas?
yeah,
Yeah, so if you use the actual expense method, you can deduct so basically what happens is like the actual expense method, say you have 75% business use, right? 75% of all the expenses related to your vehicle are going to be deductible. That would include the gas that you put in the vehicle and drive it. So that's for the actual expense method. If you're using the standard mileage deduction, it's just you're just going to be able to deduct the mileage. But no matter which one you use, you have to track the amount of business miles you have. Because for the actual expense method, you're going to determine it's going to be the amount of miles you drove total for the year. It's going to be the amount of miles is going to be the numerator that you drove for business, and then the denominator is
yep.
going to be total miles. And that's going to give you the business percent usage. So you have to track the business miles for the actual expense method. And then, of course, if you're using the standard miles deduction, you have to track the business miles to figure out what your deduction is.
Cool.
There's
Eric,
some good apps.
other questions in the chat?
Yeah, yeah. There's one other question. Are you in all 50 states?
Yeah, so we have clients in all 50 states with the exception of North Dakota. And that's just,
North
there's no
Dakota.
reason for that. There's no reason for that other than it's just the way, some reason we just don't have any clients in North Dakota. I don't know why, that could change tomorrow. But
Yeah.
yeah, right now we do have, but we do have experience filing North Dakota taxes in North Dakota because some of our clients own properties in North Dakota. They just don't live there. So yeah, to answer your question, we're in all 50 states basically. And we can, if you are in North Dakota, you're tuning into this, we can help you. We just haven't helped
You
you.
could be the first North Dakota
Yeah.
client.
Do you like ring the bell when you get the first
Yeah.
one for the state? What did they get? Did they get something? Come on.
It
Yeah.
just kind of crept. This kind of just crept up on us over the years. So, unfortunately, we hadn't been tracking it. But that would be interesting. I guess when we do have the North Dakota person, we'll have to like make an announcement. We're now officially
All 50 states.
clients in all 50 states.
Yeah.
Awesome.
If anybody wants an app like Mile IQ is typically what I've used and it's good. I know there's some other ones, but that automatically track it. Is there any in terms of with agents, investors, brokers, is there anything that you see be like a common mistake with taxes, maybe a common like miss where they're missing out on more opportunity in terms of what they could either do for write-offs or just for tax planning? Is there like something you see happen over and over again?
All right. So yeah, there's a few common mistakes I would say. The first one is not realizing you qualify as a real estate professional, most likely, and not taking advantage of that, not investing in real estate in combination with that to offset your income, which leads to significant tax deductions. That's like the number one mistake I see. There's been times where I've gone on the phone with a real estate agent and they had no idea that this exists. And I'm like,
Yep.
I can't believe that nobody's telling you that this exists. Your CPA should be fired immediately. But and I'm not joking. I'm somewhat joking about that, but they probably if they didn't tell you about that. That's the number one mistake. The second mistake I see just in general across the board, this isn't exclusive to real estate agents, but also real estate investors, is not having a bookkeeping system. Bookkeeping, documentation overall. I'll just put this all under the umbrella of documentation. Um, Documentation not only helps you make sure that you're getting all of your deductions that you're entitled to because you're keeping track of them, you're keeping your receipts, you're having like if you have a system like QBO, you're gonna have your income come in, and then you could track all your expenses in there too, and you can ensure that you're maximizing your deductions. So that's probably the second one. The third one is just documentation overall. Like you mentioned, Mile IQ, you have to track your business miles. In this case, for miles, if you're going to qualify for the real estate professional status, you should be tracking your hours in some way, shape, or form, whether it's a calendar or a spreadsheet or an app like Clockify to show that you actually met those requirements. That's going to be another one. And like just overall documentation, right, for the IRS. The third one, the fourth one I would say at this point is not working with a CPA or a tax strategist just in general, high level, because a lot of times what happens is, and this is pretty much almost everybody, not just real estate agents or brokers, but most Americans, they may have a CPA that does their taxes. or they may use TurboTax, but that's just the filing of your tax returns. And the reality is a tax strategist or tax advisor is going to help you take a look at what you have going on, like what you do for a living, what your portfolio looks like, and like the amount of taxes you're paying, and saying, okay, based on your current situation as well as your goals and what you want to achieve, here's the things you can do. Here's the strategies that you can implement, the moves you can make, so that you're going to ultimately minimize your taxes when it comes time to actually filing your taxes. So your tax return itself is just a report card of your income, deductions, so on and so forth that you had throughout the year. The tax strategy is how do you make moves and position yourself so that when it comes time to filing your tax return, whether it's this year or sometimes years into the future, that you're actually reducing your taxes. So those are just some common mistakes.
I feel like Eric asked that for himself. So let me bring up on topic of the big beautiful bill. But Eric, was that good for you? Did you learn something?
Yeah, no, I mean, I was just because there's so many common mistakes. Like I was
No,
interested to see what he sees most often.
no, I know. I'm just kidding. And we can bring back Thomas for those general conversations again in a few months.
Yeah.
So what is the qualified business income deduction, and has anything changed with that, Thomas?
Yeah, so the qualified business income deduction allows you to deduct 20% of your business income. Uh, that is the deduction overall. So if you made, let's call it 200,000, for example, you'd be able to get a deduction of 20% of that, of your net, to be clear. But if you netted 200,000, you'd get a deduction of 20K. Excuse
40.
me. That's 40. I'm
40.
sorry.
Yeah.
I messed up. It's 20%. Yeah. So it would be 40. And that was set to sunset this year. So that would not exist in 2026. They made that permanent now. There was some talk about raising it to 23%. I see some of that still floating around out there. Some people are still saying it's 23%. No, the bill's been passed. It's signed into law. It's now permanently 20%. So that's big.
No cap? Like there's no business income cap where it.
Oh no, that's a great question. There is a cap. So the cap is at right now, it's at $200,000 if you're single, or $400,000 if you married filing joint, and it begins to phase out from at that point. But what they did is they raised that, they basically raised that amount a little bit, so the threshold's actually higher.
So I think this is a common misconception. When you say phase out, right? So it's like it will be 20% up to 400, and then once you start going above 400, then for that, let's say you report 500,000, right? Then that 100 gets a lower percentage, right? Not the full 400 before that. Am I right? Or
So it actually starts, the amount that you can deduct is actually phased out. So at that point, you're going to be it's going to shift into a different way to basically, before those thresholds is 20%, no questions asked.
yeah.
What happens
After
is
two.
that, yeah, after that deduction, after that threshold, you start to come into the W-2 wage and property limits. So it's going to be 50% of your W-2 wages paid by the business, or 25% of the W-2 wages, and then 2.5% of the unadjusted basis of qualified property.
Now my brain is now exploding.
So yeah, I would say this is something. So the thing that's interesting here is that, especially for real estate agents and brokers, a lot of times you can operate as a S corporation, right? You operate as an S corporation, so you pay yourself a wage, and then you're only subject to self-employment tax, which is 15.3% up to $171,000 and change. But you're paying 15.3% self-employment tax on without the S corporation. You're paying that on your full basically income up until that threshold. With the S corp, you're only paying that on the wage, and then the profits, you're not subject to self-employment tax. And what the S corporation also allows you to do is now you have W-2 income, right? And W-2 income can impact your QBI deduction. So long story short, the big takeaway for QBI is two things. The first thing is it's now permanent, so it's not phasing out, which is good. And two is that if you are above these thresholds, the long story short of it, I would recommend speaking to your CPA or tax strategist and just finding out, okay, how can I optimize for this? How can I optimize my W-2 wage, not only to reduce my exposure to the self-employment tax, but also to maximize your QBI deduction, because it's different for everybody. And like I can't sit here and go through every
Yeah.
but the point is, yeah, like I said, the big point is 20, it's here to stay, and you're just going to want to have a conversation with a tax professional on
So
how to optimize it.
as long as if you're 200 or less, it's easy, 20%. Anything above that, you need a better strategy. That's what I'm hearing.
Unless you're married.
Yeah,
Right.
unless you're married, yeah. And I feel like this one in particular could be one that a lot of CPAs might mess up for you.
Yeah.
Would you agree?
Yeah, it can you can easily mess it up. If you're just working with a tax preparer, you're probably, they're probably just going to file your return based on whatever happened and not really help you optimize it. But if you work with a CPA who understands how to do this, you can run scenarios and basically say, okay, if you paid yourself this much, this, okay. Basically, what we try to do is try to find the optimal salary to pay yourself out of the S corporation that basically gives you the best net tax benefit. Based on, there's like a kind of a seesaw effect of the self-employment tax and then also the QBI deduction, but we'd aim to optimize that. And that's something that, that could easily be messed up or neglected entirely. But yeah, so yeah, that's pretty, you just want to make sure you're working with somebody who knows how to help you optimize it.
The S corp is something I tell every agent about. My first year selling real estate, I didn't have an S corp set up, and at the end of the year, when I did my taxes, I had to write a $55,000 check to Uncle Sam, and it almost killed me. And then I had the S corp set up, and the most I think I've paid ever since is like 8 or 10,000. So like the savings are insane once you have it set up.
Yeah, we had one financial planner, and I know it's not a real estate agent, but very similar circumstance. It could, be a very similar circumstance. He was just operating out of a sole proprietorship. We converted him to an S corporation, did reasonable salary analytics, started paying him a W-2 wage out of his company, and he saved over, I think it was $25,000 per year because of that.
It's insane.
It's a compounding effect, and on top of that, when you have the W-2, normally you're paying uh, what's the word I'm looking for? You're paying withholdings on your W-2 income, and that's going to the IRS, and that helps you manage your basically your estimated tax payments too on a quarterly basis. So a lot of benefits of setting yourself up as an S corporation.
Yeah,
absolutely.
cool.
So next question we have is, what do real estate agents and investors need to know about Section 179 changes?
Yeah, so Section 179, this is mainly going to impact you if you invest in commercial property, because there's certain things on commercial property that you're able to deduct using Section 179 that you can't use bonus depreciation for, like HVAC systems, for example. And what they did there, not much has changed. They just increased the limit. So it used to be that you can only deduct 1.5 million per year of, only deduct 1.5 million, but they raised that to 2.5 million. And they also, there's a phase out. So if you bought a certain amount of equipment, that deduction would start phasing out, and that went from 2.5 million to 4 million, and both will be indexed for inflation. So if you're a commercial real estate investor, this could be pretty big. This is also going to be big for business owners who are buying lots of equipment. So perhaps construction. This could be, if you're involved in construction at all, this could be could impact you as well.
Cool. So the last question that I have written for you before we kind of open it up even to more, how has the bill impacted qualified opportunity zones?
Yeah, so qualified opportunity zones were set to sunset also in 2026, and now that program has been made permanent. Now, much of the changes for that program are going to come in 2027. They're kind of the way the bill is written to kind of let this current version of it sunset, and then kind of it will be refreshed. So the census tracts. One of the biggest issues with qualified opportunity zone funds is the census tracts would cease to exist in 2027. So they renewed the way that those are going to be done by the states, so they can keep refreshing that. Also, the way that it worked was that if you invested in a long story short, qualified opportunity zones are like census tracts across the United States that they said these are low income census areas that we want to designate as qualified opportunity zones to spur investment into those areas and revitalize them. And in order to do that, in order to get those incentives, if you're an investor, you can if you invest in a qualified opportunity fund that essentially invest in these areas, that if you would be able to defer the capital gains tax until so say in 2021, just for example, I invested $50,000 into a qualified opportunity zone fund. I defer that capital gain. So basically you invest capital gains into these funds. So for example, say I sold an Apple stock and had $100,000 gain. I would invest $50,000 into the fund, and now I'm not paying tax on that $50,000 investment until 2026, right?
Oh, so it's almost like a 1031 exchange, and like the way you described it to me in my head. I don't know.
Yeah, it can be compared. It can be compared to that because you're deferring the taxes. It used to be until 2026, but now it's starting in 2027. It's going to be on a rolling 5-year basis. So if I invest, 50 grand in 2027, in 5 years from 2027 to 2032, you would pay tax on that $50,000 gain. Now, there's also a step up in that. If you hold it for 5 years, you're going to get a 10% step up in that capital gain. So what do I mean by that? If we go to this $50,000 example, if I held it for 5 years, I'm going to get that 10% step up. I'm only going to pay taxes on $45,000 of that capital gain. So I get my capital gain basically reduced by 10%. Now, the big, and that's just kind of like
High level.
like a cherry on of the investment. The real power of a qualified opportunity zone fund is that if you hold the investment in the qualified opportunity zone fund itself, the gain on the qualified opportunity zone interest is exempt if you hold it for 10 years. So say, for example, I put this $50,000 in, make a really strategic, wise investment in a qualified opportunity zone fund, and that investment 10x's in 10 years because it just happens to be a phenomenal investment. That's $500,000. I invested $50,000. I'm going to have a $450,000 capital gain. That's significant.
Yeah.
If I held it for 10 years, that entire $450,000 capital gain on the qualified opportunity zone fund investment itself is exempt from taxes.
Wow.
One
Oh,
one of
okay.
one of the things that I will kind of caution on this, just as like a devil's advocate, because I'm in an investor group where one of the guys was putting together a deal with this. Is a lot of times people will use these and they will kind of preach the tax haven part of it for really bad deals to get people into it. I've heard a ton of people that will pitch these opportunity zones is like, oh, it's a killer deal. You're going to avoid all these taxes, and people trying to lower their tax bill as much as possible, throw money at them, and they're absolute clunkers of deals. So just be careful. I'm not saying all of them, but I've definitely heard a
Yeah.
few for sure.
Oh yeah, no, you definitely want to obviously it's like akin to investing in a syndicate and fund, right? A real estate syndicate
Yep.
fund. You're gonna have a general partner typically, and you're gonna have a bunch of limited partners. You want to make sure the deal, like we always talk about this from the tax perspective, because we have so many people who will make tax-driven decisions, but make bad investment decisions driven by the motivation for tax savings. So we say that you always want to look at the investment merits of the deal first, or of any investment, and say, does this make investment sense? Would I make this investment if it wasn't for the tax savings? Like, is this still a good investment? And if the answer to that question is yes, then yeah, the tax benefits, they're phenomenal. But yeah, to your point, there's a lot of bad actors out there, a lot of people promoting bad deals. People do that in the oil and gas space too, because there's good tax benefits of investing in oil and gas. But there's people who have good oil and gas investments, and there's people who just have the investment that's just there for the tax savings and for the stuff. So definitely want to be careful. I don't invest with this person, and that's not it. I just don't invest in this type of fund. For me personally, my investment strategy. But there's gentleman named Brett Lindbergh, Savoy Capital, and he's a he knows how to actually invest in these qualified opportunity zone funds himself. So just as someone to check out if you ever do want to do it. I'm not tied to him in any way. I just know that like out of all the people out there, he's like one of the people who I know like actually knows how to use these the way they should be used.
Yeah. When I learned about him last year, it blew my mind. And then I started looking at the deal. And I'm like, this is not a deal. Like my mind is not blown. I was like, so I did some more research and found some more stuff out about it. So, Randy, do you want to open it up to questions?
Yeah. What do we got in the chat? Let's open it up. We can stay on. We'll have a few more minutes, Thomas, for a couple.
A lot of them.
I have some extra time. Yep.
Okay. A lot of them got answered. Alicia asked, where is a good place to research opportunity zone fund groups? Brett Lindbergh, is that who you said is good to reach out for it?
Yeah, Brett Lindbergh. You can find him on Twitter. He also did a podcast with us. If you search like Tax Smart REI podcast, Brett Lindbergh, you can find the podcast. He does a phenomenal job of breaking down how qualified opportunity zone funds work. Yeah,
Okay.
that's someone I would just you do your own due diligence and everything, of course, but it's just someone I know in the space who I look at as like a trusted figure. So
Okay. Good tool or app that you recommend to do bookkeeping, documentation, i.e. QuickBooks. I responded to that one. We use QuickBooks. I didn't know if you had a different tool you prefer.
yeah, we prefer QuickBooks Online. It just has
Hmm.
everything that is needed to do bookkeeping for real estate investors and small business owners. We had a client who was doing 100, had like 1,000 properties in his QBO account before, or their QBO, it was a fund, before they broke and they needed to upgrade to a different system. So that's our go-to system. There's other good ones out there. There's Zero. There's others. There's Wave. But we recommend and prefer QuickBooks Online, and we're not tied to them in any way. It just happens to be just a good system. So
Okay. That's all the questions in the chat. Does anybody have anybody?
No,
All right.
no, there's Claudia just posted one.
Oh,
She said, we're in a syndication fund that will come due in 8 years. If we roll it over to another investment for 2 more years, does that qualify? Do we avoid the cap gains that way too? Or is the
it
10
has
year?
to, it would have to be that opportunity zone, correct?
So yeah, there's a few ways that you can do it with the syndicate and fund. So I'll break this down high level. So when you're investing in a syndicate and fund, you're investing in a partnership interest. So you're not investing in you don't have an interest directly in the real property. You're not on the deed, the title. You have a partnership interest. And because of that, you can't do a 1031 exchange. You can't 1031 exchange your partnership interest as a limited partner into another syndicate and fund. The only way you could do a 1031 exchange is if the general partners said, we're going to 1031 exchange this property, and all the limited partners, you guys are all invited to come along with us. We're going to, 1031 exchange 123 Main Street into 1234 Main Street. Come along.
Got
So
it.
that's usually off the table. The second thing you could do, though, is what they call a lazy 1031 exchange. Now, the lazy 1031 exchange is you sell your syndicate and fund interest, or it's sold, and you're going to have a capital gain. You can go and buy a rental property directly, or go invest in another syndicate or fund, and they're most likely going to do a 1031, excuse me, a cost segregation study and generate a substantial amount of bonus depreciation, which generates that non-cash loss. That can be used to offset the gain on sale of your syndicate and fund. And that's a lot of people do that now that 100% bonus depreciation is officially back. You're going to see a lot of people, they're going to have a capital gain from the sale of their rental property or from a syndicate and fund. They're just going to go invest in another one and use the losses. That you can do. Or you can use a qualified opportunity zone fund, take the capital gain and invest in the qualified opportunity zone fund. You could do that too. Those are like three like common exit strategies that are popular.
Claudia, if you want, you can unmute yourself. I don't know if was that answered. Do you have any additional comments or questions to that?
Appreciate that, Randy. Yeah, a little bit mind blown at the moment. And God bless you, Thomas, because I know you're talking at a gajillion miles an hour. But yeah, I wrote as quickly as my hands could do. but yeah, I'll ask some questions and maybe give you a call.
Oh, okay, got it. Yeah. And this is recorded, guys. So we'll have it
Yeah.
on YouTube, on Facebook. It will be turned into a podcast, all that good stuff. But
Thanks so much, Randy.
yeah, any other questions while we have Thomas? I know we're past our time, but any one more maybe? No, that's it. All right. I don't see anything else. Cool. And
Can I
put
write off
link,
my,
Thomas, I put your link to schedule a call with you in the comments too, so they have it.
Yep.
So cool, dude. Thomas, yeah, certain points you lost me, so I got to read myself. But that's expected because sometimes when
Yeah.
I speak to my own CPA, I tell him like, hey, can you just slow that down? Like, like usually I listen to podcasts at times 2 speed, but
Right.
when I talk to my CPA, I tell him can you go at half speed, please? Like at times, because it's like, what are you talking about? And then you guys start using your abbreviations, right? Kind of like us investors, like ARVs, Mayos, and all this. And most people are like, what are you talking about? It's like same thing with you guys. Like you threw out the QuickBooks abbreviation. I realized that's what you were talking about. QBO, 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 QBO. I'm like,
Oh yeah, sorry. Yeah.
He's like, that's just the lingo. He's like, we don't say
Yeah.
QuickBooks around here.
Yeah.
Too many syllables.
QuickBooks Online, abbreviation. Yeah.
Yeah, no, it's all good.
It's
fine.
awesome, man.
We appreciate you coming on, Thomas.
Yeah.
And sure we'll have you back again. There's so much to talk about, but I really wanted to kind of stay on topic today about the big bill. But yeah, to be continued on a lot of different things. Thanks again. Any final words, Thomas?
Appreciate it, man.
Yeah, no, thank you. Final words. I mean, look, there's a lot of stuff you could do as a real estate agent when it comes to real estate. Like I said before, I think the biggest opportunity is the ability to use bonus depreciation when you acquire property. But there's obviously a lot more we talked about today: QBI deduction, optimizing that with your S corporation. I strongly recommend working with a CPA who's going to do tax strategy with you. It doesn't have to be us, but somebody who's going to sit down with you and say, "Hey, look, here's what you have going on. Let's look at the playing field and help optimize your situation so that you are taking advantage of the tax code in a way that's going to optimize you." Because at the end of the day, all this stuff is there. It's written in the tax code. There's so much stuff that people would think is crazy or illegal, but it's not. It's there, and it's up to you to somehow figure out how to use it. So tax strategists could be your best friend, and that's what I'd recommend. Just make sure you're working with somebody who can help you with that, and not just filing your taxes every year.